Yeah, so simply solventless concentrates, HASH or hash on the TSX Venture develops and manufactures cannabis products including pre-rolls, concentrate, distillates, amongst other products. The company developed the Astrolab and Fruity Hootie brands in-house and has acquired Lamplighter, Royalty, Zest, and Relax brands over the past year. As well, they recently closed on their acquisition of CanMart, expanding production capabilities just this last month. The stock IPO'd on the TSX Venture in December 2023 and has since risen a whopping 155% to 51 cents a share, resulting in a $38 million market cap at this time. So strong performance post-IPO. Some IPOs, you'll see the complete opposite where it quickly drops. Here's the opposite where it quickly rises over the next year. But it's quite good, to say the least. The company has, however, changed significantly over the past year, and that's really been reflected in the share price. So we need to keep that in mind when looking at financial metrics, as you have one-time costs, capital structure changes, revenue and cost structure changes, just to name a few type of things, which can result in messy financials and really limit any comparability year over year. So a quick look at the Q2 financials with that in mind. The company had gross revenue of $4.2 million net revenue, which is post the excise tax or the cannabis tax really of $2.9 million, a gross margin of 59%, adjusted EBITDA of $952,000, and an EPS of 2.4 cents. All these were significantly higher year over year and even quarter over quarter, largely due to the various acquisitions, so not really great comparison, which is why I'm not going to go through them. But the company did as well note organic growth. So overall, good performance, and it's roughly in line what they previously projected. At the end of Q2, the company had $110,000 of cash with $965,000 in debt and $1.3 million in leases, resulting in a net debt position of $2.1 million. So at the end of the quarter, the company really needed to raise cash. You see that only a bit over $100,000 in cash. They need to manage their working capital as well as get cash for the acquisition of CanMart. So doing so, in July they placed 15.4 million units, which consisted of share and a half warrant at 25 cents a piece, raising 3.85 million less the fees, which after the cost of CanMart put the company in the net debt position of roughly 0.6 million. But this will likely be different at the end of Q3 once you see the actual results, is to give a ballpark figure of all this movement, which is a really running thing in this company, as there's a lot of movement going on. But it's good to have a general idea of where they have on hand. But you're likely going to have different things that happen in Q3. So some things that have, as well, which will have happened, is exercise of shares, working capital changes, and so on, and then just general operationals, building or changing the cash position. The company, like I said, has been really building up that inventory in both raw materials and process, now at 12.4 million, to prepare for growth expectations. And this is to really do with all those additional acquisitions to build up additional revenue, but that also does cause them to take on additional risk, as if the company is unable to meet its sales expectations. When it has built up all this inventory, it has to sit on it for longer periods of time, which means they may need to raise more capital through share issuance, debt, and so on, just to cover that working capital. Because if they need to just pay labor costs, they need to pay their employees. That's one of the quickest ways companies can get in trouble, is they invest in a bunch of working capital. They need to still pay their employees, still need to pay their rent, and so on. And yet, if they're not selling the product at the rate they need to raise more capital. As well as we've seen this actually in the cannabis industry before. We saw significant impairments of inventory for both retail and just the raw material manufacturers, or growers, I should say, in, 2017, 2018. And then they had massive impairments, which caused a significant amount of following bankruptcies not soon after, or takeouts at dirt cheap prices. The share structure will likely significantly change if the share price remains the same, in roughly the same ballpark, as the company has significantly warrants and options outstanding. At the end of Q2, they had 53.8 million shares. The company then, after the quarter, issued 15.4 million shares. They had 26.5 million warrants exercisable at 20 cents a share, plus the further 7.7 million issued after the quarter at 40 cents a share, and another 1 million at 25 cents a share issued to CanMart as part of the acquisition, as well as 4.9 million of stock options exercisable at 19 cents. if they're all exercised, which at the current price they likely will be, it's the stock's trading at 50 cents or above at this time. And all these strike prices are in the 20s or at the highest 40 cents. They're going to get exercised come once the holders really want to. Sometimes they'll run down the clock right until the maturity date, but other ones they'll just exercise earlier, depending on what the prerogative is. And if they all are exercised, there'll be 109.3 million shares outstanding. That's over a 100% share increase since the Q2 outstanding. And that's really the cost of all these acquisitions and inventory buildup and so on, which they've done over the last year. That's the combination of it. And they would receive over 4 million in cash due to the exercise as well, though. The company has been providing guidance for Q3 2024. The company expects gross revenue of 7 million. And considering the fact we're almost done Q3, that's likely going to occur. Adjusted EBITDA, of 1 million and normalized net income of 1 million, as well as projecting an exit run rate of 33.33 million in revenue, slightly below the previously projected 34 million the company had in its slides from July's. So slightly below, but not the end of the world. That ends up only being really 2%, 3% lower. Further, they reiterate their projected 2024 exit run rate of 40 million revenue, 6.2 million adjusted EBITDA, and 6 million in a annualized normalized net income. I will note run rates, especially exit run rates, do really have a risk embedded in the assumptions as they imply the continuation of financials at that end of the quarter versus trailing where everything's been done. So there's a bit of just more risk embedded in that, but it has the benefit of being forward looking, which is something you always want to do as an investor, is look forward. However, it is not really uncommon either when a company undergoes these significant operational restructurings like Simply Solventless Concentrates has, as trailing results are really just too distant from the existing operations. You don't want to just be saying, oh, we're going to measure you on what you had a year ago. You want to measure it now, but that does have that risk. Like I said, is you really only have a point in time versus a series of times. So using the projected run rates for Q3, the company trades an adjusted run rate PE of 10.6 times, but when fully diluted, that goes to 15.5 times. I will note the market cap, which I said before, already actually had some of those dilutions, specifically the share issuance in it. So that's why it's not exactly a 100% difference. If the company is able to grow and exit Q4 at its projected run rate, it puts diluted adjusted PE at 9.3 times, which becomes more appealing, but it needs to be executed on, which is where a lot of that risk is. So concluding, the company is not trading at a high valuation, but this is likely due to the current risk. The balance sheet isn't great. While the last raise helped tide things over, the company needs to start funding its operations from internal cash flows. The company does have that share dilution overhang, which at current prices will all be executed given the discrepancy between the strike price and the current share price. The company needs to execute its projections. The price of the stock implies significant weight on relying on those projections at this time. So if any material misstep happens, that could end up causing the stock price to plummet. So really, this is just a monitor and evaluate at this time, as it's not a screaming buy, it's not a massive discount or anything. If it does hit the projections, it will probably be a good value, but you are carrying quite a bit of risk. Because if things do turn sour, it will turn sour quick. And we've seen that a few times before, to say the least, when it comes to the cannabis sector.
Okay. I got to say, I don't often, one of the statistical or the projections that they had here was a pro forma projected annualized normalized net income per share. We may calculate those as analysts for companies, internally to try to value a company, particularly in the small cap sector. Often we're saying companies, can you give us a normalized figure, or give the market? We can do the normalized figure. We'd like them to do that, but we don't typically see companies going to that extent to do this. Again, pro forma projected annualized normalized net income per share. That is not seen often. I'll tell you, I've been looking at companies for 25 years, and I don't know if I've seen that once. But again, thanks for putting that together. It is a prediction going forward, and we have to, you have to, because there's not a huge track record of that company hitting on those. We have to. It's not that we're saying management is lying or anything like that. It has nothing to do with that. It's just it's a figure that we have to take and take with a grain of salt. Kind of, we have to see management be able to execute that on that over the long term.
Particularly given the industry as well, right?
Exactly.
Because we've heard so many promises and projections made by companies in this industry, and they've, in virtually every single instance, they've underperformed.
Yeah.
Missed.
Yeah.
I mean, even like just look at like 2021. Like I recall like, several, like the amount of projections that were out there, or I think it was 2021 or 2022 with cannabis companies, the amount of projections that it was going to be such a frothy year. And then it was just cannabis company after cannabis company was just missing. And then like Brett went over, I'm glad that he did, just like the inventory, all of a sudden then we see like the amount of inventory write-downs that these companies were making because, the price of cannabis is just absolutely plummeting because all you like the barriers
It's
to
a commodity.
entry, exactly. It's a commodity. I literally got a question from that or from a client the other day, asking like, hey, would you
Well, in the
classify
entire
cannabis as
industry, at
commodity?
least here, was basically cultivation in people's basements. So,
Yeah.
Obviously it's not that difficult to grow it, produce it.
Yeah. Like,
Well,
I mean,
I
What's the
remember
competitive advantage.
I remember a particularly impassioned investor in the sector back when I spoke at the Toronto Money Show, right when it was being legalized. And I had said that we couldn't find a company to invest in that was profitable at that point. And he just was yelling, the demand will be there. The demand will be there. And I said, well, I know the supply is there because we've calculated it an oversupply, a significant oversupply. I hope the demand is there. And then you saw too many participants, oversupply, and it's a commodity and prices have come down. That's not saying that this Simply Solvents business cannot be successful. They have been profitable, it looks like, in the last couple of quarters, which is great to see. And we'll sit down with management. We'll ask some questions to the team over the course of this week. It'll be good to get their feedback on those, on some of the questions we have. And again, we can go on their current performance, which has been solid. It's the projection that I think the stock is starting to trade at, and the management team and everybody involved that's invested would like it to trade on the forward projections. Projections are they're projections and subject to risk, and whether this company can hit on those, particularly in terms of an EPS on the bottom line, not really a real EPS bottom line with the dilution that we're seeing, it remains to be seen at this point.
Yeah.
Yeah, and that's really what I was trying to get at by listing all this stuff off is there's a lot of moving parts, especially being a post-IPO company. So on top of the projections, which have dozens or hundreds of assumptions cooked into them, you also have just the structure of the company changing as well, which impacts the per share count, which is what really you should care as an investor. You don't really run off the raw net income, you're running off the per share net income. So if they just dilute you away to fund their acquisitions or their companies, not saying that they are, but that's what we've seen many, many times before. And it's something you need to be cautious about whenever you're seeing these massive capital structure changes.
100%.
For sure. That's a good summary. And I look forward to sitting down with management.
Yeah, me too. And
for sure.
Again, just it is a commodity. Cannabis is a commodity. If you guys looked in my living room, it looks like an absolute jungle in there. There's 60 cannabis plants that are growing right now. I'm joking. I only kid.
We're editing that out. That's all I can say.